Welcome, this is Tracy with noteinvestor.com, and today I'm going to shoot a little video to go along with a blog post that talks about a very important tool for note investors, and that's the split payment partial. So in this transaction, we're going to see how a split payment partial actually rescues a note purchase, and this is from our Real Deal Archives number 153. So what happens when a low appraisal strips the equity, leaving a note balance greater than the value of the property? Well, that's what happened with Real Deal number 153. Was a seller financed note on a 15-unit motel in Texas, and it had a sales price of $160,000 with a down payment of $20,000. And the seller had carried back a note for the buyer of $140,000. So that note was secured by the real estate, and the buyer was making payments to the seller instead of a bank. And they financed that for 11% for 30 years at $1,333.28 a month. And when this note came to us, 151 payments hadn't been made. So there was a remaining balance still owed of $123,836 and some change. So that's the balance that the buyer owed to the seller after they'd made 151 payments, and that was the amount that the seller was interested in cashing out, so they didn't have to wait for the remainder of the term to get the funds. So there are 209 payments remaining on that balance. So in the pro column, this looked like a great deal. It was well seasoned. It had over 12 years of payment history. There was good equity to the sales price. You know, the buyer had put some money down and they'd made payments, so they were about a 22% equity to the sales price. The buyer had personally guaranteed, and there was great credit, A credit on the transaction. And there was an emotional investment on the side of the buyer because not only did they own and operate that motel, they also lived in an owner's unit on the property. So a full offer was made to purchase the whole note, all the remaining payments for $111,880. So obviously there was a discount built in there to achieve a higher rate of return on that investment as an investor. So in the con column, a new appraisal was ordered. So this is normal due diligence, right? Everybody's agreed, looks like a great deal. And now we go to due diligence. We get all the paperwork and the title report and appraisal. And this was a drive-by appraisal. And unfortunately, it showed that the fair market value of the property was not the $160,000 sales price anymore. It was now $123,000, just based on some economic conditions in the area along with comps. So remember, the balance was $123,836 and some change. So the balance was actually a little bit more than the value of the real estate, the item we would take back if the buyer quit paying on the note. So now what? Well, in a lot of situations, this might just be the transaction canceled, but in this case, there were enough pros going for it. Remember, on that pro column, all those things were still there except for that equity issue. So the challenge was there was no equity now. So the solution for an investor then is to limit the investment. So they can't change what the buyer owes against the property. They can't change how much the property is worth, but they can lower their investment so that it is a safer transaction. So the investor reduces their offer to obtain a 70% investment to value. So ITV stands for investment to value, and in this case, to calculate investment to value, take the value of the property, the fair market value that came from that appraisal of $123,000, times it by 70%, which is 0.70, and you get the $86,100. That's the maximum amount the investor could invest if they wanted to keep a 70% investment to value. So challenge 2, that low ITV creates a big discount. That's hard for the seller to swallow. The offer was $111,880 and now it's $86,100. So the seller's thinking, that is a big discount. I might understand why the investor doesn't want to invest more, but boy, is that a big haircut on the full purchase. So the solution is a partial purchase. It's not necessary for the seller to sell all the payments. It's not necessary for the investor to buy all the payments. So what is a partial purchase? Well, a full purchase is just what it sounds like. It's the purchase of a note in its entirety. So there were 209 payments left, so that would be buying all of the 209 payments. A partial purchase is purchasing just a portion of the note. So it could be a portion of the 209 payments. So it could be, say, 180 of the 209. That would be considered a straight partial. Or it could be a split partial, where the amount of the payment is split up every month between the investor and the seller. So in this case, we had challenge number 3. The seller was older and they just didn't want to wait on future payments. So a straight partial is where the investor would get the payments up front and the seller would get them on the back end. So the solution here is, as you guessed it from the title of this presentation, is the split payment partial. To actually start with that payment that was next due in 30 days to split that up every month. This way the seller could receive money at closing, plus a portion of each remaining payment. They didn't have to wait way off into the future to get their portion of the partial. So to calculate a split payment partial, we start out with what the investor was willing to invest. So the present value that they were willing to invest, remember, was that 70 ITV of $86,100. And they wanted a 12.25% yield. And we know there were 209 monthly payments left. But we don't know how much of each payment they need to buy to get their yield for their investment. We know the whole payment amount, but we're trying to figure out how much is that investor going to need to buy of each remaining payment. So we put it into our chart like we teach in our How to Calculate Cash Flows training to always identify the knowns and then solve for the unknown. So we put it in the 86,100 PV, 12.25 in the I. We're going to solve for payment. That's our unknown. We know there are 209 payments. So I'm going to pull over our calculator. I'm going to use the HP 12C as an example here, but you can use t-value or 10B or whatever calculator that you like to use. So here we've got 86,100, change sign present value, 12.25 GI for the interest or the yield that the investor wanted. We're going to skip payment because we know we're going to solve for that. We have 209 that we're going to put into N, and now we're going to press PMT to solve for payment. So we'll see we get $998.46. So that is the amount that the investor would need to buy of each monthly payment, $998.46, to get their yield on that $86,100 investment. So that was a split purchase solution. That's how this transaction closed. Remember, just to recap, there was $123,836 and some change left on the note with 209 payments of $1,333.28, and that note paid at 11%. The investor did their investment and they're going to receive $1,000 a month. Now that gave them a little bit higher than the 12.25 yield because we just rounded that $998 up to $1,000 a month. It's just easier, it's simpler to have one of the parties receiving an even amount and the other to receive the balance. So the investor is receiving $1,000 a month, which gives them about a 12.28% yield if everything pays as anticipated. And the seller received their funds at closing plus $333.28 every month from the remaining 200 monthly installments. So when that $1,333 comes in, $1,000 goes to the investor according to the terms of the partial agreement, and the balance gets sent on over to the seller every month. And that can be done through a third-party servicing entity that splits up and keeps track of the full balance, the investor's balance, and the remaining partial balance. And in this transaction, we had one more win-win-win situation, and that is there was a broker that received a referral fee as well. So a lot of common questions sometimes come up when we talk about partials, whether they be split payment partials, balloon splits, straight partials. How do I calculate it? How do I calculate the yield, the term, the payment amount? How do I document it? How do I explain it and show the amortization schedules to the seller so they understand it, or and their attorney understands it if they're involved? Well, the solution, we have the How to Calculate Cash Flows online training, and that has over 50 videos that it describes different ways to structure a transaction, how to calculate that on the HP12C financial calculator, and how to calculate that in the t-value amortization software. And we have that along with helpful tips and articles over at noteinvestor.com/bookstore, or you can visit noteinvestingtools.com as well, which is our direct link to our bookstore. So I appreciate you joining me today on how a split purchase partial rescued this real deal number 153. So thanks and happy note investing.